Hi everyone, I'm Ching. Welcome to my first video of my YouTube channel. The reason why I decided to do a channel is because I would like to educate more people on stock markets, on equities. It is also one of my passion to teach people, and it's also one of my hobbies. I like to analyze companies, I like to analyze the markets. And so far it has been quite rewarding. Right, so today we are going to talk about inflation and interest rates and how it will affect the stock market and equities and also valuation. As we all know, inflation is at the all-time high for the past 40 years. On the 10th of June, the US has released their inflation data at 8.6%. That is the highest in about 40 years. So what caused the inflation numbers to go up so much? I'm sure all of us are experiencing increased food prices, increased petrol prices, increased transport prices, increased air ticket prices, or everything that you're looking at. Prices have increased, right? And why is that? The reason is because of oil. As you can see, the price have increased from COVID lows at around, at one point it was at negative, I think $10 or negative $20. As of today, it is about $118 per barrel USD. What we are looking at is a historically high oil price, and it has been caused by the war in Russia and Ukraine. But historically, when we look at oil price, should usually trade at around $60 to $80. That is a reasonable level. But at above $100, or maybe we may be crossing above $150, that will cause everything to go up. That's not good for companies that need to produce goods and services. Alright, their costs will go up. When inflation is so high, they will have to pay their employees more, so on and so forth. Let's look at the past and see how did all these oil crises affect us and the stock market. There are two periods in history whereby oil price were very high. One is in the 1970s, the oil crisis in the Middle East, right? They call it the Yom Kippur War. I'm sorry, I don't know how to pronounce that. And the Iran Revolution, whereby oil supplies were disrupted. So at the time, Egypt and Syria, they launched an attack against Israel. It is very similar to what we are looking at now. Right, the world has opened up. Economies are opening up. Unemployment rate in the US is at the lowest in many years, right? And naturally, consumption will go up and people will want to spend. So there's about 1.5 trillion to 2 trillion of savings in everybody's account because the government has been giving so much money to everyone that there is so much pent-up demand to spend. But the thing is, there is a limited supply, all right? And oil is very important for economic growth. And again, you look at the 1979, 1980s, right? There was the Iran-Iraq war, and which also affected oil supply. All right. So at the time, by July 1980, all right, the oil price was $30. In today's value, is about $100, right? In today's number, right? At the time, it was $12.70, and it doubled to about $30. Right. So at the time, OPEC was producing about 40% of oil supply. So looking at today, the EU imports a lot of oil and gas from Russia. Russia currently supplies 27% of the EU's imported oil and 40% of gas. That's why we are seeing oil and gas prices going up. Because by the end of 2022, which is this year, they are thinking of reducing the supply or cut down their supply totally from Russia, in order not to fund Russia's war. There will be a reduction in supply of oil. Somebody has got to step up, be it OPEC, be it the Middle Eastern countries whereby they are oil producing countries, or the US. They got to step up their production. But the thing is, during COVID and all these years, right, if you look at oil price, because oil price was so low, there's less incentive to invest in supply, in the production of oil, right? To explore oil and all that. So there's definitely a reduction in supply, right? And of course, if there's more demand than supply, oil price would have to go up. And that's what we are seeing over here. Okay, inflation is at the highest in 40 years, 8.6%. Okay. And interest rate is at the lowest historically. And we have another problem. The Federal Reserve is more reactive than anticipating where inflation is. So if inflation is high, They are always late to follow up with where inflation would go, and they are very late into raising their Fed funds interest rate. As you can see over here, at inflation above 5%, usually Fed funds rate always keeps up above inflation, right, in order to control inflation. But historically, the Fed is more reactive. When inflation is high, then they will start to raise their rates more aggressively, so they will be more hawkish. So in this month, the Federal Reserve would likely increase the Fed interest rates at 50 basis points, which is 0.5%. And it goes the same for the next month and the month after. Alright, so we are seeing Fed funds rate increasing their interest rates to about at least 3% in order to keep up with where inflation is. And if they raise inflation rates, it will likely dampen demand, which is what they are trying to achieve. If demand is lower, inflation rate would hopefully go down. Alright, but historically we see that in a runaway inflation, right, it's not going to be easy to control it. The Fed, the governments have no control over it unless they can stop the Russian war, unless they can bring down the prices of oil. And how will interest rates affect the valuation of stock prices? Let's take a look at what Warren Buffett said about interest rates.
I mean, it surprised me when you said you didn't think the market was overvalued relative to historical ratios, right?
Well, you've got to crank in interest rates because everything in valuation gets back to interest rates. And if you take the U.S. Treasury bill now, which is we'll call it 80 basis points, depends what maturity. That means the U.S. Treasury bill is selling at 125 times earnings. Now, if your alternative is to buy something at 125 times earnings, or a good business whose earnings will probably increase at 15 or 18 times earnings, you've got to measure it against the risk. It isn't really a risk-free instrument, but the standard rate. And in 1982, the rates got up 15% or thereabouts, and that makes a lot of difference. I mean, you've got a choice with money. What do you do with it? In Europe, if you put it in the bank, you will be charged for having it there. I mean, it's better to keep it under your mattress. So, you've got a choice every day as what you do, and I think equities are cheaper than fixed dollar investments.
What did Warren Buffett say is, at a time, interest rates, the Fed interest rates was at 80 basis points, which is 0.8%. Alright, and at that time it was very low. If you look at the yield based on price to earnings ratio, alright, you take 1 divided by 0.8, you get about 125 times earnings. But if you look at the time in the 1980s, whereby interest rates is very high, it reached as high as 20% or 15%, that would give you earnings of about 6 times. So if you compare at interest rates of 125 times versus interest rate of about 6 times, where would you put your money in? If interest rates was at 15%, would you put your money in the stock market or you put your money in the bank? Most people will likely put their money in the bank to achieve a 15% return of interest rates. That is how it affects stock prices. So many people, if interest rates were at 5% versus interest rates at 1%, where would you put your money? Federal Reserve, as of yesterday, Wednesday, June 15, they have increased the Fed funds rate to more than 75 basis points. Previously, they were estimating the Fed funds rate to go up by 50 basis points, which is 0.5%. But now, because inflation was at a historical high for the past 20 years, they have to increase the Fed funds rate more aggressively by 75 basis points. And overall, they are targeting for interest rates to go up to as high as 3.4%. So what does it mean for valuations over here? If you look at what Warren Buffett has said, valuations would have to compress. If you look over here, IR is interest rates. Interest rates is at 1%. So we assume that we are looking at a company with a market capitalization of 20 billion. Revenue is 1 billion. So having a 30% margin would be $300 million. You take 300 million divided by 1%, that would give you a valuation of 30 billion. So if the Fed funds rate from 1% before COVID increased to 2%, we are looking at a drop in valuation of about 50%. Right now we are here, the Fed funds rate is targeting at the end of the year to be about 3.4%, or maybe higher if inflation can't be controlled. So over here we are looking at from 3% to 1% is a 60% drop. And then if we are going to 4%, that would be a 75% drop versus what we are seeing in terms of valuation 1 year ago during COVID times. And if inflation still can't be controlled very well, the Fed funds would have to increase their interest rate, maybe, and I hope not, to about 5%, right? And that we are seeing an 80% drop. So over here, what we are looking at is from 1% to 2% is a 50% drop, from 2% to 3% is additional 30% drop, from 3 to 4 is additional 25% drop, and from 4 to 5 is an additional 20% drop. Right now we are over here, and if it's going to 4%, we are looking at 25% drop, and right now we are here, if we are going to 5%, we are looking at a 40% drop. That is a discount from 3% interest rates. So likely, we will look at a lot of companies that will be trading at a lower multiples because interest rates has risen. The Federal Reserve would need to control inflation by raising interest rates. So what kind of investments can we look at? Alright, so currently if you're looking at bonds are not going to do well. Okay, if you're looking at the 10-year treasury yield, just for this year you're looking at 10-year treasury yield going up from 1.52% to 3.15%. Same for the 5 years, same for 2 years, same for 1 year. They are all going up near to 3%. Alright, the only one that you can really invest in is your treasury bills. Alright, it's like your fixed deposit that it doesn't go down. So for 2022 year to date, you're looking at all these bonds going down, negative returns. Bonds won't do well in a high interest rates environment. Alright, if interest rates are going to go up, bond prices have to go down. So there's an inverse relationship between interest rates and bond prices. How about Bitcoin? Right? If you look at this, I compared Bitcoin to the Nasdaq for this year. As you can see, there is quite a close correlation with Bitcoin and Nasdaq. So it seems pretty speculative if you think that Bitcoin is a good hedge for inflation, maybe not for high inflation. So it seems that Bitcoin is the one in blue, Nasdaq is the one in yellow. It seems to correlate very closely, and I think as of yesterday, Bitcoin dropped quite a bit, and I think Nasdaq will actually follow through. It has been correlated quite closely so far for this year. Of course, not so for the past 5 years. Okay, so if you look at gold, how is gold doing this year? Gold is only up 3.69%. So if inflation has been consistently high at 8.6% or higher, it will still give you a negative return, real returns. Okay, and I think the only one that you can look at is more of oil and gas, Energy Select SPDR, but it has went up quite a bit already. It has went up about 50% year to date. I'm not sure if oil price is at the peak or at the top. If we were to go into recession, which probability that I think is pretty high. It depends on how aggressive the Federal Reserve is going to raise their rates. And of course, if they are in a catch-2 situation, if they don't raise rates fast enough, they won't be able to clamp down on inflation, to dampen down demand. And as you can see, crude oil prices are at the top now. All right. So I'm not interested in buying a lot of oil and gas companies to hedge inflation, even though a lot of these inflation numbers are caused by oil, because everything, you have to use oil for everything. You have to use oil to make your plastics, you have to use oil to deliver all your goods, transportation, your Grab, your Uber, everything. If you look at the stock market, all right, the equities, the S&P 500, we are in a bear market territory. The S&P is down about 18%. Most likely it will go down more as the Fed raises their Fed funds rate, interest rates, and that is how they affect valuation, as you can see over here from this table. And so how am I going to invest? I'm not sure. I'm pretty much on the sideline now. Even if you have a lot of cash on the sideline, you're still going to lose money if you have cash. It is better than your stocks going down by another 20 or 30%, which is what I'm looking at. I think that the probability is quite high. But what I'm still interested in is growth stocks, because once the valuation comes down at a more reasonable price, at a more reasonable valuation, even though it's a very good company, but a very good company can be expensive and it can still cause you to lose money. So I'm looking at companies, at very good growth companies with a strong moat, with a good pricing power, right? If they are able to grow very well and at the right valuation, maybe I'm looking at interest rates of 5%, and if they can give me at a price that I'm looking at, I will definitely start going in and buy. Thank you everyone, and that's all for today. If you like this video, please click subscribe and like, and click on the notification button so when I have more videos coming up, you can be notified immediately. And thank you very much. Bye bye.